federal flood insurance is only the NFIP laws was amended in 1969 to provide coverage for motorcyclists and again in 1973. Until then, the purchase of flood insurance had been voluntary, with only about 1 million policies in force. The 1973 amendment put concentrates on the use of federal funds in high-risk flood plans, a measure that was strains on the use of federal funds expected to lead to almost universal flood coverage in these zones. The law prohibits lenders that are federally regulated, supervised, or insured by federal agencies from lending money on a property in a floodplain zone. When a community is participating in the NFIP, unless the property is covered by flood insurance. Legislation was enacted in 1994 to tighten enforcement of flood insurance requirements. Regulation can now find banks with a pattern of failure to enforce. The law and lenders can purchase flood insurance on behalf of homeowners who fail to buy it themselves, then bill them for coverage. The law includes a provision that denies federal disaster aid to people who have been flooded twice and have failed to purchase insurance after the first flood. Buildings constructed in a floodplain after a community has met regulations must conform to elevation requirements when repair, reconstruction, or improvement to an older building equals or exceeds 50% of its market value. The structure must be updated to conform to current building codes. A 2007 NFIP study on the benefits of elevating buildings showed that due to significantly lower premiums, homeowners can usually recover the higher construction cost in less than 5 years for homes built in a velocity zone where the structure is likely to be subject to wave damage, and in 5 to 15 years in a standard flood zone. The Federal Emergency Management Agency (FEMA) estimate that buildings constructed to NFIP standard suffer about 80% less damage annually than those not built in compliance. How it works? The NFIP is administered by an FEMA, now part of the Department of Homeland Security. Flood insurance was initially only available through insurance agents who dealt directly with the federal program. The direct policy program has been supplemented since 1983 with the private-public cooperative arrangement known as Write Your Own, through which a pool of insurance companies issue policies and adjust flood claims on behalf of the federal government under their own names, charging the same premium as the direct program. Participating insurance receiving an expense allowance for policies written and claims processed, the federal government retains responsibility for underwriting losses. Today, most policies are issued through the right your own programs, but some non-federally backed coverage is available from the private market. The NFIP is expected to be self-supporting. Premiums are set at an actuarially sound level in an average loss year as reflected in past experience. In an extraordinary year as Hurricane Katrina demonstrated, losses can greatly exceed premiums, leaving the NFIP with a huge debt to the US Treasury that it is unlikely to be able to pay back. Hurricane Katrina losses and the percentage of flood damage that was uninsured led to calls for a revamping of the entire flood program. As with other types of insurance, rates for flood insurance are based on the degree of risk. FEMA assesses flood risk for all the participating communities, resulting in the publication of thousands of individual flood rates map. High risk areas are known as special flood hazard areas or SFHAs. Flood plan maps are redrawn radically, removing some properties previously designated as high hazard and adding new ones. New technology enables flood mitigation programs to more accurately pinpoint areas vulnerable to flooding. As development in and around flood plains increases, runoff patterns can change, causing flooding in areas that were formerly not considered high risk and vice versa. People tend to underestimate the risk of flooding. The highest risk areas on A have an annual flood risk of 1% and a 26% chance of flooding over the lifetime of a 30-year mortgage, compared with a 9% risk of fire over the same period. In addition, people who live in areas adjacent to high risk zones may still be exposed to floods. On occasion, 90% of all natural disasters in this country involve flooding, and the NFIP says since the inception of the federal program, some 25 to 30% of all paid losses were for damage in areas not officially designated at the time of losses as special flood hazard areas. NFIP coverage is available outside high risk zone at a lower premium to prevent people putting off the purchase of coverage until waters are rising and flooding is inevitable. Policyholders must wait 30 days before their policy takes effect. In 1993, 7,800 policies purchased at the last minute resulted in $48 million in claims against only $625,000 in premiums. Proposals for change. The NFIP has four major goals: to decrease the risk of flood losses, reduce the cost and consequence of flooding, reduce the demand of federal assistance, and preserve and restore beneficial flood plan function. In a final report published in 2006 by the American Institute for Research (AIR), which conducted an evaluation of the federal flood insurance program. AIR said that although much had been accomplished, the program fell short of meeting its goal, in part because the NFIP did not have the ability to guide development away from floodplains and cannot restore beneficial floodplain function once they have been impaired. In addition, AIR said many people still are not covered or not adequately covered for flood damage. AIR also noted that the NFIP was hampered in reaching its goals by insufficient congressional funding, lack of patient data, misperception about the nature of the program, and the breakdown in coordination among its three major sectors.